If rising inflation and low interest rates are eating away at your savings, you're probably looking for a better strategy. That's where Realty Income, the REIT that's earned the nickname the best monthly dividend company, comes into the picture. In this video, I'll show you how much return you and John can get from investing $100,000 in Realty Income, why it's better compared to other REITs, how it stacks up when the market is down, and in the end, we'll find out if this REIT can turn $100,000 into $1 million portfolio. But first, let's set the scene. You're probably looking at your savings or investment accounts thinking, this can't be it, can it? How can I make my money work for me without becoming a day trader or sacrificing sleep? It's a question many ask, especially with inflation lurking around every corner and interest rates that feel more like a joke than a reward. So what do most people do? They start looking into alternative investments that can generate consistent passive income. That's where REITs, real estate investment trusts, come in. But not all REITs are created equal. Some are risky, some are underwhelming, and some, like Realty Income, are game changers. This investment not only earns you dividends, but pays you those dividends every month. Kind of sounds like the Holy Grail, doesn't it? Well, that's Realty Income in a nutshell. Named one of the best monthly dividend companies, Realty Income offers a solid dividend yield of 5.5%, beating many, if not all, savings accounts and government bonds by a mile. While those might give you the bare minimum or even lose value against inflation, Realty Income keeps things moving in the right direction. But why Realty Income? Good question. If you're exploring the world of REITs, it can feel like a crowded party. You've got heavyweights like Simon Property Group, which has a larger market cap of over $65 billion, and more specialized REITs like Kimco Realty Corporation. But Realty Income stands out for a few key reasons, and it's not just because they've got income in their name. First off, let's talk about their market cap and size. Realty Income sits pretty at over $50 billion, which positions it firmly as a major player in the REIT space. But size alone isn't everything. Realty Income has carved out its niche by focusing on single-tenant net lease properties. This type of lease means the tenant is usually responsible for property taxes, insurance, and maintenance, so Realty Income can sit back and collect rent with fewer headaches. Now, you might be thinking, what about the other big names in the REIT world? Well, let's consider Simon Property Group for a moment. SPG's properties lean heavily into shopping malls and high-end retail spaces. While that's good during an economic boom, it's not exactly recession-proof. When people tighten their wallets, luxury retail and malls are some of the first places to feel the pinch. Realty Income, on the other hand, has a diversified tenant base that includes businesses providing essential services like pharmacies, grocery stores, and convenience chains. These are places that see foot traffic no matter what's going on with the economy. So while SPG might ride high during good times, it can also hit turbulence faster. Meanwhile, Realty Income is built for the long game. Now, take a look at the valuation numbers. Realty Income's PE, price-to-earnings ratios, might seem a bit higher, which some might interpret as it being a pricier stock. But here's the thing, investors are willing to pay a bit more for a company that's proven its reliability time and again. Think of it like buying a car. You'd probably pay more for a model that's known to last 20 years instead of gambling on a cheaper car that might break down after a few years. That is Realty Income, the reliable choice, even if it comes at a slight premium. Now let's get into why Realty Income's business model is way more dependable. Unlike many REITs that dabble in different property types and face challenges with unexpected costs, Realty Income's focus is crystal clear: long-term net lease agreements with top-tier tenants. These leases aren't your typical short-term agreements either. I'm talking about decade-long commitments. So while other property owners might stress about their tenants skipping out or sudden maintenance bills, Realty Income has built a system that takes those worries away. Here's where things get even more interesting. The tenants in Realty Income's properties are often well-known investment-grade businesses. This isn't a random collection of startups that could vanish overnight. We're talking about solid names that operate in sectors essential to everyday life. Like I mentioned earlier, grocery stores, pharmacies, and convenience store chains, the places people will still visit even when they're cutting down on expenses. Places like Dollar General, 7-Eleven. This quality of tenant acts like a cushion, insulating Realty Income from some of the volatility that other REITs might face. If we break down the valuation numbers, Realty Income's price-sales ratio at 9.38 and price-cash flow ratio at 14.84 might seem higher compared to others, but here's the catch. You're buying into consistency. When you choose a REIT, you're not just buying into properties, you're buying into the management's ability to maintain those properties, secure reliable tenants, and navigate through economic challenges. Realty Income's long-standing reputation for doing just that is worth the higher price tag. And let's not forget about their financial health. Realty Income has maintained a balance between growing its portfolio and managing debt responsibly. This careful balance is key to ensuring that even during periods of economic turbulence, they can keep those monthly dividends coming. Their conservative debt profile ensures they don't overextend themselves, which in the real estate world is a big deal. Over-leveraging can turn a profitable REIT into a financial cautionary tale faster than you'd believe. Now remember, in the end, I will answer the question, can this REIT make you $1 million? And does it have what it takes to pay a six-figure annual dividend income? So let's get to the part everyone loves to hear about. Dividends. Realty Income's dividend growth is not just nice to have, it's a defining feature that sets them apart. With a track record of paying and increasing dividends for over 26 consecutive years, this REIT is part of the Dividend Aristocrats Club, a select group of companies with over 25 years of consecutive dividend growth. Why is this important? Well, it's one thing to find an investment that pays dividends, but finding one that consistently increases those payouts over decades is like striking gold. And Realty Income doesn't just maintain its dividends during market crashes like the 2008 housing bubble or the 2000 dot-com bubble, it actually has a history of raising them. Here's an added bonus: their commitment to paying monthly instead of quarterly. It might sound like a small detail, but getting paid every month allows for more flexibility and faster reinvestment of dividends if you're aiming to compound your returns. Okay, we've reached the point you've been waiting for. What's the real long-term payoff if you put $100,000 into Realty Income today? Let's walk through the projection and show why this investment might be the financial game changer you and John are looking for. I'll break down the numbers over 10, 20, and even 30 years to see how your initial $100,000 grows into a fortune. Let's set the stage. Realty Income has a current dividend yield of 5.5% and has a track record of consistent growth, standing at about 3.93% on average every year. Over the years, you and John don't contribute any additional funds, but reinvest every dividend earned back into the stock to maximize growth. And based on that, here's the future projection of investing $100,000 in this REIT. In 1 year, that initial investment will grow to $107,640. Fast forward to 10 years, and that $100,000 has more than doubled, reaching $217,989. By the 20-year mark, the portfolio grows to an impressive $528,608 as reinvested dividends and capital appreciation continue to drive growth. However, the biggest rewards come at the 30-year milestone. Here, your initial $100,000 has multiplied over 14 times, ballooning to $1,453,582. And at that time, this portfolio will pay an annual dividend of $120,115, or a monthly dividend income of about $10,010. In total, This investment has the potential to add $1,353,582 in value to your portfolio, with $285,675 coming from capital appreciation and $1,067,817 coming from reinvested dividends. Want to know how to turn a $100,000 investment into a $20 million portfolio? Click the video on the screen to find out.